Hey everyone, and welcome to today's DeFi Drop, which features Baptiste Cota, Chief Business Officer from Midas, the Berlin-based asset tokenization protocol that has become one of the most important pieces of RWA infrastructure in DeFi. With $2.1 billion in assets issued, 43 million in yield distributed, and 50 million Series A raised recently, backed by Franklin Templeton and Coinbase Ventures, and a bespoke symbiotic partnership, I think we're in for a pretty good chat today. Baptiste, I was at the Midas event at ETHCC this year. I got to know a lot of your team. It was awesome to meet everyone in person as well. The event was absolutely amazing. It really was. But welcome.
Pleasure to have you at the event, and thank you for having me.
No, thank you. It was such a great event.
Luckily, it wasn't too warm in the Cannes sun, so we could enjoy the view and not sweat too much. But yeah, it was good fun compared to last year.
Yeah, definitely. Well, look, enough from me. I bang on a bit too much at the start of these, but let's hear from you. We all know Midas well. Well, maybe some don't, but those who have been around in the space for even just a short while should most definitely know of Midas. But I want to know a bit about your story, your background, and what drew you to the RWA space. And then we can delve a bit deeper into Midas itself and where you guys are going.
Yeah, definitely. So my background's in finance. I started working in London for Goldman Sachs in equity research. Actually, I was working at the time with Dennis, who's currently CEO and co-founder of Midas. So we'll talk about that later, but that's kind of where it started. And I did that for 4 years. Was a great learning environment. And then decided to do something a bit crazy, which was quit my job with a colleague, a woman, and launch a venture capital fund from scratch, to invest specifically in the blockchain space, and more particularly with a thesis around the idea that institutions were coming, that institutions would lead to growth of the space, but that products, services, etc., were not available for them and to cover their needs. So that was back in 2019. Quit in the middle of crypto winter and went all into the space. So yeah, it's been a while. So I did that for 6 years. We raised 50 million, deployed in about 20 startups. Startups like Talos, for example, or Kiln, or Token Terminal, or Bitpanda, etc. And in parallel, then I started launching Midas. Started as an advisor. Really passionate about RWAs. I would say, before quitting Goldman back in 1819, I started mining ETH at home. I started getting interested in Ethereum, and tokenization was something already talked about. And with my financial background, always something I believed in. Still very hard and hard to distribute and hard to grow, but I believed in. So, yeah, when Dennis said, "Do you want to join?" and with my appetite for being quite entrepreneurial and quite involved with founders and quite active, it felt like a natural progression to go from the investor side to the entrepreneurial side. So yeah, I made the jump and not looking back. It's been good fun.
That was a hell of an intro. Great background, of course, leading Midas in the right directions, as we can all tell. But let's talk a bit about the actual state of the market right now.
Yeah.
See a bit where Midas is at in this current date. So fear and greed is near historic lows. We actually just saw another big drop in the markets over the last week or so. For reference, today is the 8th of June or 9th of June, actually. So we've just seen a bit of a drop. There's a slight correction now, but October was peak. Exploits have damaged confidence. Midas just closed 50 million Series A, which I mentioned earlier, with Franklin Templeton on the cap table as lead investors. And 73% of institutional investors plan to increase crypto exposure this year, right? Why is institutional behavior moving in the opposite direction to retail sentiment right now? What does that actually tell us where DeFi is heading?
Yeah, I think there's two reasons for that. One is the institution's timeline and the way they look at things is much longer than the average crypto holder, and the current state of the market, we could say. So any announcement that you've seen has been worked on for 6 months or maybe a year, And these moves are slow, and so there's real commitment behind it. It's not a market drop that changes everything. If it is, I mean, I'd be very surprised if institutions got to their level, or the level with that kind of approach. So that's for one. And I think that the second is, if we think about more tokenization and linked to this fear and greed, I think, and I think more widely about crypto and blockchain, crypto prices itself will matter increasingly less to what's actually being built on chain. And I think that's good for the space, actually. Um, BlackRock didn't wake up one morning and see BTC going up a lot and think we're going to tokenize a money market fund. They knew about the technology for a very long time. They knew about the potential. They thought it through. They mapped it out. They launched. They grown the product. And the price of BTC is kind of irrelevant. No, so I think over time we'll see a decoupling. I would argue at some point we'll also see tokenized assets be worth more than actually the crypto market cap. And maybe as another stat that's interesting, we're about to launch with a new asset manager. Their AUM is equal to the BTC market cap. BlackRock's market cap is like 14, 15 trillion. Sorry. So, Bitcoin market cap is what, 1.3. So it's big and small, right? So I think over time, yeah, it won't matter. The rails are powerful. It's been proven. Stable coins are everywhere and payments are everywhere. Tokenization will in turn be everywhere, and DeFi will all benefit from it, to be honest. And I look forward to that and creating real value on top of just, price appreciation of various tokens and BTC.
Exactly, it's the value, right? And that's what has been lacking, I guess, in recent years, is people actually seeing that value. But we're starting to see that. Yeah. It's coming. I was actually talking to SumCap recently. SumCap, they're investors in Midas. We work with them. That's sumcap.xyz. Those guys are working on a piece that will go public soon. This study frames this better than anything I have read. Building a leveraged RWA position can be atomic, but closing it is structurally broken. The token lives on chain. The asset does not. So entry is cheap, exit is expensive and slow. Is that the core problem Midas is solving? And how do you explain it, or explain this to an institution that thinks tokenization has already solved access?
Yeah, this is the tricky piece, and if I take a step back on the question, it's a massive topic. Something we work on day in, day out at Midas is, how do you make RWAs compatible with DeFi and compatible with the way that people are used to interact with tokens? And it's tough, right? Because tokens and all tokenized assets, all tokens live on chain by nature, as you mentioned. And so it just makes it very easy to have everything atomic. Now, we have to build workarounds, basically, to enable our tokenized assets to behave as much as, any token on chain. And so I think we work on two levels. One is what we do to the RWAs we issue, and the other is how can we educate and how can we change and how can we work with DeFi protocols to evolve to match these RWAs. But on the first piece, what can we do with RWAs? The most important thing here is liquidity and atomic liquidity. So we've built a product called MSL, which currently is funded from our own capital linked to our 50 million raise. We will be opening it to the public probably this summer. What it enables atomic, meaning instant liquidity for any token that we issue. We also have built in a number of solutions within it. I think we'll discuss it more, but holdbacks, loans, etc., that protect it from price arbitrage. A number of scenarios that can happen on chain, because the reality is, if you tokenize an asset that's off chain and you've got something that's instantaneous, you can't price instantaneously something that's on chain currently. And that just doesn't exist. So there's always an arbitrage risk, something we want to clearly avoid. So we've built a number of solutions. And the other side is changing DeFi. So the problem that it takes time to redeem is also because people are effectively borrowing or looping with open, variable rate, floating rate, open-ended loans. But if they could have fixed term loans matching the underlying, then it wouldn't be an issue. At least not from getting squeezed If they need liquidity, they still have an issue, but at least everything matches. Asset liability matches. Currently, it's not the case. So fixed rate, Morpho, that's a very powerful initiative. And also education as a whole. We do speak with crypto investors who sometimes just want the world. They want 8% return, instant liquidity, and no drawdowns. I mean, the truth is, if you see that, there may be a problem in this market. If rates go up, no. But if you see that today, if you see 8, 9, 10% with never no risks, I'm sorry, they're just not telling you the truth. There are risks. It's just how it is. Or it's a massive amount of token which may go down in price, but if you sell the right time, maybe you get it. But that's it. It's not. There's no magic, right? So there's a lot of education we do, and I would also flag it's funny thing for me is we're in a bit of a bipolar space. Like people want BTC aping to meme coins on one side, and on the other, it's like we want zero loss products and high yield. It's like, well, actually, that barely exists at all, by the way, and a lot of people that say they're doing it is a bit misleading. So, yeah, a lot of education and innovation on RWAs in DeFi to summarize.
That's great. We can go to the education side just now, but you did mention Midas Stake Liquidity,
Yeah.
MSL. This is your answer to the exit problem. So external depositors commit stablecoins, earn yield for absorbing the duration gap, and their loan is senior to M token holders. So they carry duration risk, but are protected from credit risk. Can you walk us through how that actually works in practice? What happens when the buffer cap is hit? That's very important. And what your honest answer is to the stress scenario where redemption flows across your M tokens all correlate at once.
Yeah. So, so I think there's two key mechanics for MSL. There's the loan to an M token portfolio. So let's say someone wants to redeem M token A, instantly. When they do that, the M token A portfolio borrows from MSL, and those stable coins are then sent to the redeeming investor. Now, only part of his redemption request is actually sent back because we have a holdback. So we have two mechanisms, loan and holdback. The loan protects MSL by giving seniority. So if we say MSL applies to, and we always have a limit, say 10% can enable instant redemption for 10% of an M token, that means that the loan is backed by 9x its value. So it's very safe, right? If you do it in LTV terms, it's an extremely safe loan. Now, to also protect the M token, the holders of M token A, the people that are not redeeming, from a situation where the redeeming investor is redeeming at a price that may be too old or too high. Let's not forget that the price is on chain and it may not be correctly pointing to the off-chain price because we don't have every second, every block on-chain price. That's just not possible for off-chain assets. Maybe one day, okay, we'd love to do it and we're working on solutions to improve, but that's extremely hard. Then we have a holdback. So that means that depending on the volatility of the assets, we'll give you 90 cents on the dollar straight away, or 95 or something like that. And then once we get a new NAV, you get the rest. So then you pay a fee, but that fee is only here to pay for liquidity. You're not paying for price risk. So you're only paying for duration risk. You're not paying for price risk. We're protecting MSL. We're protecting M token holders. So we really think it's a pretty innovative solution. And so that pool will sit actually in DeFi lending market. So it will generate a base yield, and then it will generate extra yield based on the amount of instant redemptions that happen. To your question, what happens if everyone asks at the same time? Luke, I think we're quite transparent here, and this is really how we function, is that it is subject to availability. Instant redemptions is subject to availability, and if everyone withdraws wants to instant redeem at the same time of every single product, it won't be possible. There's a point where it'll just be empty. Now, I think interestingly, this never happened even during stream finance fears or some of the stress events that we've had. And we can cycle and get the redemptions done so that MSL gets refunded and invests again. There's also a benefit that means high returns for a product that's very senior, actually. If you really think about how it works, it's very safe. And so we actually think that will attract capital. So there's a number of mechanisms for that. But ultimately, in the absolute max one event, there may be limitation links to the size of MSL, and there is definitely limitations as well to the percentage of a token that can be withdrawn instantly as well. Full total instant for everything within an M token would mean per block price on chain and instant liquidity sitting idle on chain equal to our TVL. So that is very difficult, but I honestly don't think it's needed. The other point I would say here is most of our products are T+1, T+2, T+3. So, people really have it. Why has it never been fully drawn? Because people have a deep think. Do I really want to pay the fee or can I wait 2 days? And the truth is, when you get to it, a lot of people will wait 2 days. That's what we've observed as well.
What's striking about the holdback mechanic, sorry, just going back a bit, is it's essentially the same NAV haircut as a prime broker applies on day one of a redemption gate, no? Or a vault holding tokenized private credit can't liquidate in a single on-chain transaction is what I'm trying to say. And NAV updates may arrive sort of daily or less frequently, no?
Yeah, I mean, I'd rather not use the word redemption gate because that kind of scares people that you log them in. But I would compare to, if you go to a market maker and you tell them, I want to sell M token A to you. He's taking price risk. He's taking duration risk. He needs to make money out of that, and that's normal. And he'll, depending on the risk of the asset and the time between buying and redeeming, he could price you 97 cents on the dollar, 95. We'll price you a 10x factor cheaper because we're not taking the same risks as he is. And so that's what the holdback really does. The holdback says, we don't know what the price is. We know that it won't fall further than the holdback. So within the time period that we need to get the NAV, so we'll give you everything, we'll give you 90 cents on the dollar, 95, and we'll give you the 10 or 5 cents minus a instant redemption fee, which depending on our product range from 10 bips to 100 bips in the highest. So you can see it's always going to be much cheaper.
Okay. I'm actually an M token holder myself in various positions, so
Thank you.
it's not new to me. Loving it. Actually, across a few RE7 curations as well, so which I'm enjoying. So look, Midas has expanded from MT Bill, your first flagship product, into credit, basis trading as well, MEV strategies, BTC. But not every TradFi product is a genuine candidate for tokenization. The exit infrastructure required, the settlement cycle, the liquidity profile under stress. All of this constrains what can be made composable. So which asset classes are you most excited about for the next wave, and which which ones does the industry talk about tokenizing that you think are structurally unsuitable?
Yeah, structurally unsuitable. I think we still talk. I always, when I hear this, I think about real estate. Like it's a constant thing that's been around like for literally 6, 7 years. Like when we were first starting talking about STOs, I think it was 2020 or 19. Maybe it was 19 STOs after ICOs. Like that was kind of the slogan. Like I struggle to see it for now, but I think if we take a step back, it goes to education, because from an infrastructure perspective, we can tokenize anything. It's really not a problem based on the legal entities we have and the legal structuring we have, and the connections we have, or accounts or custodians, or we can access anything. But the question is more, can it be distributed on chain? Is it palatable to on-chain investors? Are there DeFi composability use cases or not? That's something that evolves over time. Honestly, like back last year, people were looking for mid 15% returns. They were willing to take risk. Why? Because you could make 8-9% on Morpho lending vault. So you wanted more, you wanted to loop it, now we're seeing demand for high single digit returns. So we've launched a product a month and a half ago called M Global. That's an asset-backed credit fund managed by Fasanara. That's their flagship 3 billion AUM fund. We are working right now on an investment grade and CLO combined product to offer mid-single digit returns, very safe returns, premium over T-bills. So we're more looking in those kind of debt assets, quite very principal protected, as limited, I'm always very maybe too honest, but where credit risk is close to zero, where duration risk is very low. But by here I mean interest rate duration, because that can have impacts. So in order to not have impacts moving rates, so no to very low drawdown risk products with single to mid single digit yield is where the market kind of wants to be right now, and that's what we're launching. And I would say, as we continue with education, as the market continues to evolve, as investors start to continue to diversify in what they're actually doing on chain, I think we'll see more demand for other products. But for the next 6 months, that's where we'll be, and we'll have a few products coming out along these lines. I'm also excited to launch a Euro product soon because it's starting to pick up, and as a European, why not? there's increasingly a market, and we think it could happen.
And what about your, going a bit off script here, but
Yeah.
your views then on European regulation, this ever so sensitive structures that are building here? Do you see this being a bit slower? Like, I'd love to know what your inputs are.
Yeah, I think there were some good things, like we needed clarity and transparency. If you compare to the US, we were feeling quite good up until recently, because the US had this regulation by enforcement, lack of transparency, and everyone worried and not building and spending too much on lawyers. So at least we kind of knew that's a benefit. There's a tendency to be heavy, but I don't want to do too much European bashing. In the tokenization world, the DLT pilot regime, which was not very talked about in pure crypto space, was actually very interesting. It had a number of flaws which limited adoption, and I don't want to get into boring detail, but the idea behind it, the belief by the regulators, ESMA, etc., in public blockchains very early on, countries like Switzerland, now France, and a number of others recognizing native on-chain, lead registers on-chain, etc. Like those are very advanced moves and quite early, actually. So, I think, yeah, on balance. But now the Europe needs to keep moving, because the US is going to accelerate really, really strong, and that's what we're seeing, which is super exciting. We have the SEC chair saying in 5 years we tokenize all US equities. So, we need to get moving.
Yeah, we do need to get moving. Things are a bit bureaucratic here. We know that, not just in this space, but in general. So yeah, hopefully we can catch up. But look, you've talked about the products Midas is issuing. But the moment those tokens sit as collateral on Morpho or Pendle, the quality of the strategy underneath them becomes someone else's problem too. So let me bring that to the curator side of things. Let's look at creator relationships directly.
Yeah.
You mentioned Fasanara on before, but Fasanara on M Global, RE7 on MRE7 Yield. I mentioned that earlier myself. I'm a fan. Could you walk me through the legal mechanics? Who actually controls the fund? Who owns the underlying assets? How is responsibility split between Midas and the curator? All of that stuff. And also, if a curator makes a bad call and simply wants to walk away, what's the off ramp?
Yeah. So
a lot of questions. I'm really sorry.
Definitely. So look, the first thing I say, it is complex because there's various products and there's various ways of working. But there's a few truths that are very important to us. And then I can go into to some detail. But one is, Midas never actively manages products directly. We're not an asset manager. And to be honest, this is also something I just flagged for everyone deploying into crypto. Like if you deploy into something where you have a feeling that there's some degree of active management, be very careful if the protocol or project is doing it itself, because it's a job. Like people, have experience or don't. So where active management is needed, we have a professional asset manager doing the work. Token holders themselves always face us. We issue the tokens under European securities regulations, and they face us with rights that are varying because we have different issuing entities, but they're always completely transparent, and legal docs are always available, obviously. And then the manager itself, we contract with the manager. So if we're tokenizing a fund, for example, our entity will invest in the fund. So we'll be an investor in the fund. If we were tokenizing a strategy where the strategy is actually run in the entity that is tokenizing, that is issuing the token, then then we basically sign an agreement, an investment manager agreement, where the manager has legal obligations to manage the strategy as we have defined, which is exactly also the way that they're described in the legal documentation for token holders. So you have back to back here. And to your question, I think your question is, and then what happens if a manager wants to stop? Your question, or if something goes wrong, or yeah.
Like, if a curator decides, okay, things aren't going so well,
Yeah.
and they want out, what's their off ramp?
So we can all, I mean, if a curate, yeah, I mean, and I would call them more managers, but the curator word, or we call them strategy managers. The curator word tends to be more for, I would say, in our view, we more like to differentiate, because for us there's quite a lot of active management. More for curators, role and responsibilities are much smaller, and the risks are significantly lower, for example. But I would say, if they want to stop because they want to do something else, we can either change the manager, we can name a different manager for the same token, the same strategy, or we could decide to shut the product down. But in the end, this is not a situation where any funds are at risk in no matter, because the funds are never in direct control of the manager. Either they're in our direct control, or they're within a fund. And they're not going to steal money out of a fund. There's a lot of legal risk that they would take, and that's just not going to happen.
Okay, gotcha. Yeah,
This is where it's, I would say, it's legally, if we talk about stream finance, for example, I don't know how it worked legally. I know that token holders barely had any rights, probably, or very undefined. I don't know how they were contracting with external managers, because I understand they had multiple. In our case, all of that is very heavily worked on with multiple legal counsel. So everything is very clear, and responsibilities and clear, and liabilities are clear as well. And that in turn protects token holders. And that's extremely important.
Yeah. Stream finance reference is well worth landing on hard, actually.
Yeah.
We can give it a skip for now, I think, so we can keep things focused. But a quick hop over to lending markets. So every lending market that lists an M token quietly inherits your entire exit infrastructure, whether or not they priced that correctly. But the size of your MSL, so Midas Stake Liquidity, for those who didn't catch it at the beginning, so the size of your MSL buffer effectively becomes a parameter of their solvency with no direct control on their side. You've mentioned a bit, but you're now live on Morpho, Pendle, and 20 other protocols. How do you think about that responsibility when you size the MSL?
Yeah, I mean, I would say we work as partners with curators. We work day in, day out with them, and the solvency of DeFi markets is an absolute priority for us. Now, of course, it is, you mentioned, it is a responsibility of curators to set the LTVs, to set the allocation caps, etc. And the instant liquidity and the risk of the product and the duration of the product are all parameters that impact that calculation. Now, I would say, we want to grow MSL as large as we can, because that helps the solvency of DeFi markets. But it's not the only solution, because I would say we have 3 layers of instant liquidity. And then I also would add that most of our products, anyways, being T+1, T+2, T+3, we've seen liquidators liquidating and just redeeming, because that's not that long, and the liquidator bonus is actually quite material. So, you always have that path. That path never disappears. But if we really want atomic, which I don't think is always absolutely needed for solvency, then we have 3 layers. One is internal liquidity. The second is MSL, and the third is OTC partners or liquidity providers we have. So on certain products, at least liquid products, I would say, for example, MF1 or M Global, we have liquidity inside the product. So there's 10% of the product that is instantly redeemable, and that's deployed either in T-bills or, in the case of M Global, deployed into Aave. So that if there's a redemption, it automatically pulls the funds out and sends them through. So that's within. Then you've got MSL.
Who
which would,
decides the OTC partners?
and the OTC,
Pricing in a stress event, for example.
yeah. So the OTC partners for Global, for example, working with Fahrenheit themselves, with Infinify, with Symbiotic, Liquid Lane that we've announced recently, and others. It is OTC. So here you will be transferring your M token. So the liquidator or anyone that redeems needs to transfer the M tokens to one of these parties and get stablecoins back. So that is a bilateral agreement. In the case of Fasanara, they've got substantial capital and interest to do this. They also understand the underlying really well, so they can be very confident in it. So I think they can be competitive on price, but in the end, it is a bilateral trade. So we're working on making, for example, with Symbiotic or others, to make it very simple for people to say, kind of bulletin board style, I want an RFP style, I want to sell X amount, give me a price. And then we're working very hard on educating a lot of liquidators, market makers, on what our products are, so that they can efficiently price it. So again, that's where there's education. But yeah, in the end, it is up to the OTC partners.
That's a genuinely useful framing, actually. There's three layers of liquidity with inbuilt reserves, MSL, and OTC bilateral agreements,
Yeah.
as the backstop, and the point about T+1 to T+3 being workable for liquidators in practice, it's worth holding on to. But look, let's step back from the mechanics a bit,
Yeah.
because underpinning all of this is something most protocols in this space simply haven't done. Or maybe that's an exaggeration. That might be being a bit harsh. Let's say a lot or a few, but I don't want to point fingers. But
Yeah.
what most haven't done, which is coming up. So Midas spent over a year getting authorized by Liechtenstein's FMA, structured under German law, I believe. Can you walk us through what that process actually involved, what it concretely unlocks that an unregulated competitor cannot offer,
Yeah.
and with Micah's transitional period ending on the 1st of July, literally 3 weeks away?
Yeah. I mean, I think, because I also don't want to shoot everyone in the space. I make a difference between real DeFi protocols that are quite decentralized, that they tend to be more lending based platforms or DEX style. There are other models that have worked, but real DeFi protocols often don't need to get licensed or regulated or issuing documents approved or whatever combination, at least for now. And I don't see a problem there, to be honest. Where it gets tricky is that we're not a DeFi protocol. We're a tokenization business. The products we issue point to actively managed strategies. They point to various assets. They're transferable. They're permissionless, secondary. Products we issue are securities. And when you issue securities, laws apply to you. And a lot of people in the space, and there I will take a shot, are issuing products which are securities without appropriate, authorizations, licenses, documentation, and also risk disclosures, I would argue. And so this is where the work that we've done, means we are doing things by the law. We are issuing securities in Europe under European securities regulation, notably through a prospectus approved by the FMA, as well as various other ways of issuing. And we disclose all those risks, all the risks and the obligations and the rights, more importantly, of the token holders are very clearly defined. And that protects everyone. It protects us. It protects the token holders. Everything is quite clear. Mika is not really relevant to us, but yeah, I'm quite curious to see what's going to happen, because a lot of platforms just didn't manage to get it. So yeah, I think that's a tricky situation. And I hope people will I don't know, manage it on the last minute, or grace periods will be given. I don't know. I'm not an expert there, but yeah. But all in all, to some regulation over time is going to be helping token holders and investors as a whole, and will help democratize the space and bring flows in. Without it, you're not getting institutional, you're not getting all the institutional grade platforms that then service the wider retail population. Talk about bringing blockchain to everyone and your grandmother. Like, they're not going to get a MetaMask, so, and these guys are not going to move if they don't know what they're doing and they're legal and compliance are like, I don't know what we're buying. So we need to define
Absolutely.
things.
Absolutely. I totally agree with you.
It's not
We
fun,
have to,
but we have to.
yeah. It's really not fun. I had to go through a bit of the microprocess myself a couple of
Yeah.
years ago. But that this actually lands us in a good place on the regulatory architecture, and it leads me into something I want to discuss now, which is what happens when something actually does go wrong. You've mentioned a bit about this, but you've described the attestations, the on-chain reserves, institutional custodians. That's the safety story as it appears in the documentation. But for the skeptical risk committee sitting across the table, the question isn't whether the structure is sound. In normal conditions, it's what's what its actual tail risk is for the M token holder. If you had to rank the failure modes honestly, smart contract bugs, custody failure, and underlying fund event, for example, what keeps you up at night?
Yeah, I mean, look, it's a tough question to answer, but I would actually take your order the other way around. I would say it's more the strategy underperforming, which is a clear risk, clearly disclosed to everyone. But we still like to have strategies performing super well, obviously. And that's aligned with everyone. If we talk about like a hack or what happened to or like funds being stolen, things like that, I think one thing, and this goes back to us not being a DeFi protocol, if funds are invested through a custodian, into real assets, North Korean hackers can't hack a smart contract and steal them. They're not on chain. So in that sense, I think our attack surface compared to a DeFi protocol is lower. Okay, I'm not going to say we can't get hacked. Everyone can get hacked. But you can see how, if someone hacks them global, they just can't access the funds. Like, they're in a fund. Like, it just doesn't work like that. But having said that, we're doing a massive amount of work on our smart contracts audits. We've got, internal security. We team, we've got OPSEC audits. We've got a lot of things we're doing, and it's very important. It takes a lot of time. It's also sometimes not very fun, but you have to do it. What I would say is, and sorry if I'm going on that again, but all the risks that we have are disclosed. So if anyone that invests in our products wants to understand the risks, I would say the easiest thing is to go in our docs. We have a risk part in the docs. Everything is explained. Every single investment that you make is governed by a specific legal document, which does list all the risks as well. And so I'd say we're clear and upfront. And our products themselves, they're built with risks in mind. We issue investment products. We don't issue yield-bearing stablecoins, which are inherently flawed quite often. Think the STRC-backed stablecoin and had issues recently. We're not actively managed DeFi vaults, where you're investing in what is a fund, but you don't have rights. So there are risks, but we disclose them, we mitigate them. We issue products with defined investor rights that are also transparent, with transparent risk disclosures and a legal framework that will hold up under scrutiny and protect rights, basically.
Yeah, and it's all there to read. Anyone can get their hands on it. But yeah, it's been a strange year this year. Obviously, it's at the back of everyone's mind right now. Any interactions on chain? I mean, I've just gone up a level every time I, connect to anything, or even before I connect anything, I'm just on red alert the whole time. But that distinction you just drew, the fund sitting in a custodian, unreachable by a smart contract exploit, is actually the key architectural separation most people miss. The on-chain layer handles issuance and redemption logic.
Exactly.
And the off-chain custodian holds the actual asset, and the off-chain legal structure acts as a second line of defense. But yeah, look, I think you guys are in an amazing place. That last Series A round sums it up. People don't invest on those terms and at that level without knowing they're backing the right horse. it's really impressive what you guys are doing. And I'm loving being a user of Midas, but also from our perspective at Portals, we have a wealth of listings of your positions on the Portals platform. I think we just verified another huge batch of them as well. We have these
Amazing.
verification processes whereby we connect with protocols, and we cross-check and cross-reference every position we can to verify them, to make sure they're all genuine and everything. So yeah, we're loving working with you guys. We love working with the team. We hope to keep this relationship going with Portals as well, and keep adding more of your positions on our platform. And
I appreciate the partnership.
Yeah, no, thank you. As you can tell, I'm slowly wrapping up here because time is of the essence, but I'd like to finish with our one question that we always end with. It is a bit of a game. It's not serious. And it goes like this. The total TVL of DeFi right now, as per DeFi Llama, is $72 billion. Okay.
Yeah.
What do you predict this number to be on New Year's Eve this year? So New Year's Eve of 2026, 27.
New Year's, okay.
Yeah, 1st of January. Let's call it the 1st of January.
Okay, yeah, that's okay. That's okay. We don't have to be too precise. Yeah, I want to be bullish, but on the 6-month view, it's tough. Let's call it 110.
Wow, bullish, excellent.
Yeah.
So we've only had one bearish.
Okay.
Only
if
one.
you work in this space, you have to believe, right? You have to be optimistic. So
yeah, and that one guy doesn't have a job anymore.
Yeah, there you go. Sorry for him.
Yeah, no, I'm kidding. But look, it was great having you on. I really appreciate your time. Thank you very much, Baptiste, and good luck with everything going forward.
Thank you for having me. Thank you very much.
Thank you.